Okay, today we are going to talk about property, plant, and equipment, also called fixed assets, plant assets, operating assets, and these are non-current assets. Think about your classified balance sheet. Current assets will either convert to cash or get used up within 1 year or less. Non-current assets, such as property, plant, and equipment, will take longer than a year to either convert to cash or get used up. We have three primary categories in non-current assets. Long-term investments, and that could be stocks and bonds and other companies that we're going to hang on to for a long time. Property, plant, and equipment, and intangible assets. Okay, so today we're going to talk about property, plant, and equipment. And again, it goes by a variety of names. These are the most common types of assets found in the property, plant, and equipment account. Land. Now land, notice, land does not get depreciated because land's going to be here for an awfully long time. However, everything else is man-made. Buildings, machines and equipment, computers, vehicles, furniture, fixtures, such as this overhead projector hanging from our ceiling, which I know you can't see, but anything attached to a building, okay, is called a fixture. Land improvements, things like fences, parking lots, landscaping, lighting for parking lots. Okay? Land improvements is also a depreciable asset. Okay, so these are our primary assets. All of them will have different useful lives and different salvage values. And when we look at depreciation, which is one of our main topics today, we'll see how that plays itself out. Now, there's a few things we need to kind of talk about and define before we get into actual calculations. First, when we talk about an asset's cost, the definition of cost from an accounting standpoint is all costs that we incur to get the asset ready for its intended use. This is the amount that's going to get debited to the fixed asset account, and we're going to depreciate this cost over the useful life. Okay? Now, let's take land as an example. In addition to the purchase price of the land, any broker's fees, any title search costs, any attorney fees, any property taxes called delinquent taxes that the previous owner didn't pay, we would have to pay that. That would be included in the cost of the land. In the event there was an old building that we wanted to tear down, demolish, remove, and then grade the land and get it ready for a new building, like our factory, for example, all those costs of grading and clearing and demolishing, all those charges get charged to the property, plant, and equipment account, the land account, and that's included in our cost. Okay? For a building, in addition to the purchase price, okay, or the cost to construct it, we have architect's fees. Again, we may have broker fees. Okay? If we buy an existing building and we gut the inside of it to reconfigure it to serve our purposes better, all those costs get included in the cost of the building, the amount we debit to the building account, and then we depreciate that amount. For machines and equipment, any sales tax, any shipping costs to get it to our place of business, if we have to bolt it down to the ground, if we have to modify it, if we have to weld some parts onto it so it's doing what we want it to do, all those costs, including testing to make sure the machine's running properly, all those costs get included in the cost of the land, the machine, and that's what gets debited to that account, and then it gets depreciated. We're going to look at three methods. I just want to check briefly in case I skipped a slide there. Okay, this thing advances pretty quickly. We're going to look at three different depreciation methods. There are a few others, but given that this is a financial accounting class and it's not an advanced accounting class, we're simply going to look at a straight line, which is by far the most popular method and the easiest method. We'll look at the units of activity method and the double declining balance method for depreciation. Okay, we're going to do examples for all three of these. Okay, this was the slide I'm looking for. Some useful definitions which I would like for you to know. First, depreciable cost equals cost less salvage value, okay? Or some salvage value, sometimes called residual value. This is what we think we're going to recover at the end of the asset's life when we sell it. Okay, what are we going to salvage, recover? Okay, so cost minus salvage value, this is the amount of the cost that we're not going to recover, the difference, and that's going to get depreciated. We're going to spread out that cost, allocate it over the years that we're going to use this asset. So that's the depreciable cost. Don't confuse that with the book value. And notice I'm going to abbreviate book value, BV. We also sometimes call book value carry value or carrying value. And this is cost minus accumulated depreciation, the value of the asset that we have to report on the balance sheet. We call this the net book value, cost minus the amount of depreciation we've recorded in all previous periods since we purchased the asset. Okay? So each year, accumulated depreciation gets higher and higher, or more and more. It accumulates, hence the name. And as accumulated depreciation increases, the book value of the asset, which is the undepreciated portion of the cost, goes down. Okay? Notice, depreciation is how we allocate or spread out or distribute the cost of an asset over its useful life. And we're doing this because we have to follow the matching principle or the matching concept. Remember, accrual accounting, two basic rules: revenue recognition and the matching principle. How do we recognize expenses? And what do? We match them to the same time period that they relate to the revenues they help to generate. So we can measure revenues and expenses for each time period under accrual accounting rules. Notice, it does not try to determine this piece of equipment's market value. We'll determine market value when we sell this asset down the year, and we will see an example of that. Notice, we cannot depreciate an asset below its salvage value, since this is the amount that we expect to recover at the end of the asset's useful life. And that's a hard and fast rule. We cannot depreciate an asset below salvage. So the book value can never go below salvage value. And I'm going to show you an example of what happens if we do it and how do we correct that. Okay, so these are useful definitions that you would be wise to commit to memory for exam purposes, if nothing else. Okay, now we're going to look at some depreciation examples. And for all of these examples that we're going to see today, we're going to base them on this information. Here's our data. The cost of a truck, $130,000. This is a big 18-wheeler, okay, with a big, strong engine in there, hauling heavy goods. We estimate that we're going to have this thing, the estimated useful life, for about 5 years, and we're going to drive it about 200,000 miles. And at the end of the 5 years and 200,000 miles, we think we're going to be able to sell it for about $20,000. So we call that the salvage or residual value. Now notice the cost, and we talked about cost a moment ago, all costs we incur to get this truck ready for its intended use. That's a hard number. We know exactly what that number is. Salvage value and estimated useful life are estimates, which means they may not be exact. And that's okay. We'll deal with those estimates and the difference between estimates and actual down the road. Okay? Now, I'm also giving you the number of miles this truck was driven each year because we're going to need this information for the units of activity method. And we'll refer back to this. Okay, year 1, 2, 3, 4, and 5. Okay, these are the actual miles we drove. We estimated about 200,000. If you were to add those up, you'd see that we actually drove it a little bit more than we estimated, and that's fine. And bear in mind, even though I estimate 5 years and 200,000 miles, if I want to hang on to this for 6, 7, 8 years, I can do that. It's my truck. If I want to sell it after 2 or 3 years, I can do that as well. If I can find someone who will buy this thing for $30,000, even though I estimated $20,000 salvage, I will sell it for $30,000. On the other hand, I may only get $12,000 because the condition's not as good. Okay, so again, these are estimates. They will not be right on the money, and that's not a problem. We can deal with that in accounting. Okay, so here's the first method, the straight line depreciation method, which I'll abbreviate SL. And the formula, which you need to know, is cost minus salvage value divided by the useful life. Now, the cost of our equipment was $130,000. Okay, so $130,000 minus the salvage value of $20,000 divided by 5-year useful life. This gives us $22,000 of depreciation expense per year. Okay, right on your slide there, $22,000 depreciation expense per year. If I need to have monthly depreciation, I simply divide that by 12 months. If I want quarterly depreciation, I divide it by 4. The journal entry to record depreciation for any time period, month, quarter, year, using any method, straight line, units of activity, double declining balance, is always debit depreciation expense, this case, if it's annual depreciation for $22,000, and that goes on the income statement. That's an expense. Credit accumulated depreciation $22,000, which we said was a contra asset that goes on the balance sheet. Okay, now I'm going to put two T accounts on the board. Here's property, plant, and equipment. Remember, we always record at cost. All those costs we incurred, $130,000. And right next to it is my accumulated depreciation account. And here's my depreciation for year one. Okay, now let's go back for a moment. Using this asset, let's go back to our previous definitions. My depreciable cost, which we said was cost minus salvage, would be 130 minus 20 is $110,000. And what we're going to do, I'm going to erase this up here since it's on your slide, is I'm going to put up a timeline here. 1, 2, 3, 4. 1, 2, 3, 4, 5 years. And notice, each year, I'm going to depreciate $22,000. So I'm not going to record an expense all in year one. We capitalize these assets. And the word capitalize means we put it on the balance sheet, and then we spread out that cost. We depreciate it over its useful life. That's the matching concept. So instead of recording expense all in year one or all at the end in year 5, we divide the depreciable cost, cost minus salvage, $110,000 divided by 5 years, and each year we depreciate $22,000. Okay? And again, the journal entry to record depreciation is always debit depreciation expense, credit accumulated. Notice, this is an adjusting journal entry. Depreciation expense gets closed out at the end of the year because it's a temporary account. Remember what we said in a previous lecture, an adjusting journal entry will have one income statement account and one balance sheet account. We have that. Depreciation expense goes on the income statement. Accumulated depreciation, which we said was a contra asset, that goes on the balance sheet. Now, a contra asset, just to refresh your memory, has a normal credit balance because it's opposite, contra to an asset, and we know that an asset has a normal debit balance. And we subtract the balance in accumulated depreciation from the cost, and that gives us our book value. So on the balance sheet, at the end of year one, December 31st, my book value that I have to put on the balance sheet is 130 minus 22, or $108,000. Each year, I'm going to record this same journal entry. So let's just take a look at what this is going to look like in our general ledger. End of year 2, I'll put 12/31/02 here. Here's year 1 and year 2 depreciation. At the end of year 2, we have $44,000 in accumulated depreciation. Okay, therefore, my book value of 130 minus 44, if my math is correct, book value is $86,000 at the end of year 2, December 31st. Year 3, same thing. I now have, at 12/31/03, $66,000 in accumulated, and my book value is going to continue to go down. 130 minus 66,000 would give us a book value of 64,000. Year 4, accumulated is 88,000. And remember that number after year 4. We're going to come back to that particular number for another example. My book value at December 31st, 04, 130 minus 88 would give me 42,000. And then year 5, end of year 5, end of the estimated useful life, notice that my accumulated depreciation is 110,000, and my book value, 130 minus 110, is 20,000, which is also my salvage value. We are not allowed to depreciate an asset below salvage value. Remember that. Do not depreciate an asset below its estimated salvage value, since that's the amount we think we're going to recover at the end of the useful life. Okay, and those are the rules of GAAP, so we have to follow those. Okay, so straight line depreciation, cost minus salvage divided by useful life gives me annual depreciation expense. Again, all I got to do is divide by 12 if I want to do this on a monthly basis. Okay, I'm going to record $22,000 each year for 5 years, and on my balance sheet I record fixed assets at their book value at the end of each year. Okay, and we can figure this out by creating T accounts and showing how the accumulated depreciation account keeps increasing and our book value keeps going down. Pretty straightforward. Okay, now we're going to look at the units of activity method. So I'm going to erase this data. All right, and we're not spreading out depreciation over time. Instead, we're saying we're going to drive this thing, we estimate 200,000 miles over its life. And so what we're going to do, and notice the formula, here it is, well, I'm going to point to it. The numerator, cost minus salvage, 130 minus 20, stays the same. But the denominator, okay, underneath, instead of using 5 years, we're going to use 200,000 miles. And so, on your slide, 130 minus 20 divided by 200,000 miles gives us 55 cents depreciation expense for each mile driven, per mile driven. Okay? We're going to use that 55 cents per mile driven to calculate depreciation for each year. Now, let's go ahead and take a look at our schedule here. So, year one, we drove 35,000 miles. For each mile I drive, I depreciate 55 cents. So in year one, my adjusting journal entry at year one is debit depreciation expense, credit accumulated depreciation, 19,250. Okay, and then notice year-end book value, cost minus accumulated, 130 minus 19,250. Book value is 100,750. Year two, we drove 50,000 miles, so we have more depreciation. The journal entry, debit depreciation expense, 27,500. Credit accumulated, 27,500. That's the journal entry. This schedule is going to show you the value at the end of 2 years. So don't make that mistake, okay? What you're looking at on the schedule is not the journal entries. The journal entry, remember, debits always have to equal credits. Debit depreciation expense, 27,500. Credit accumulated, 27,500. Our accumulated depreciation at the end of year two, 12/31/02, is 46,750. And then our book value, cost of 130 minus accumulated of 46,750, book value 83,250 at the end of year one. Okay, year three, multiply 48,000 miles, the miles we drove, times 55 cents, and we get depreciation at 26,400. Journal entry, debit depreciation expense 26,400, credit accumulated 26,400. The accumulated depreciation account at the end of December 31st, 03 now has a balance of 73,150. Therefore, my book value, 130 cost minus 73,150, book value 56,850. Year four, 45,000 times 55 cents, 24,750. Okay, journal entry, depreciation expense accumulated, 24,750. Accumulated now has 97,900 at 12/31/04. Book value at the end of the fourth year, 32,100. 130 minus 97,900. Now watch what happens. This is where you have to be careful with this method and the next method, the double declining balance method. In year five, when I drove 37,000 miles, I multiply that times 55 cents, and that gives me 20,625. If I add that to my accumulated 20,625, that's going to give me a balance of 118,525. When I subtract 118,525 from cost, my book value would be 11,475, which is below salvage value. I can't do that, so I can't use this calculation. I'm going to cross this out. Just cross this out like this, okay? And so instead, I have to look at my accumulated depreciation account, and this is just something you have to think about. You have to say, okay, I've learned this. I just have to remember as we get later on in the asset's life, I may not be able to use the full calculated amount. If my accumulated depreciation is $97,900, and I know that my salvage is 20 and I can't depreciate book value below 20, then the amount of depreciation I can take is the number that's going to make my accumulated depreciation equal $110,000. Because 130 cost minus 110, book value 20 equals salvage. So the difference between 97,900 and 110,000 is 12,100. That's on your schedule highlighted in red lettering. That's the amount of depreciation I can take in year 5. Debit depreciation expense, credit accumulated, 12,100. That will make my accumulated depreciation 110 and my book value 20,000. Book value now equals salvage value, no more depreciation. We can continue to drive this truck for as long as we want. It's our truck, we own it. We simply cannot record any more depreciation because we have what's called a fully depreciated asset. Okay? So on your own, take a look at that schedule, and hopefully you can construct these numbers and make some sense out of them. We're going to move on to the next method, and that's the double declining balance method. This method is a little bit tricky. I'm going to erase these numbers here. Okay, again, same data. Now, with the double declining balance method, and notice on the bottom it says this is referred to as an accelerated depreciation method because it allows more depreciation expense to be recorded in the early years and then less depreciation expense in the later years. Okay? And notice right above that, this is the only method in which we do not subtract salvage value from the cost to determine depreciation expense. I'll show you what I'm talking about. One of the most common mistakes students make on the exam. Take note. Okay, 3 steps before we start recording depreciation. First, calculate what we call the straight line percentage. And the way we calculate it is 1 divided by whatever our useful life is in years. Now, in our example, the truck we estimated was a 5-year asset, so 1 divided by 5 equals 20%. Go ahead, do it on your calculator, confirm that. 1 divided by 5 years, we would depreciate 20% each year using the straight line method. Step 2, double the straight line percentage, and that'll give us what we call the double declining balance percentage, which in this case would be 40%. Okay? Each year, we're going to record 40% depreciation based on the beginning book value of the asset, and I'm going to show you the calculation next. Step 3, multiply the beginning of the year book value times the double declining balance percentage, which in this case is 40%. Okay, so we're going to put these 3 steps into action, okay, and just bear in mind that this is the only method which we are not going to subtract salvage from cost in the beginning in order to calculate what our depreciation expense is. Okay, here we go. Again, same data. Cost 130, salvage 20, 5-year life. Straight line percentage, first step, 1 divided by 5, 20%. Second step, double that, so the double declining balance is 20 times 2 or 40%. Now look at the schedule that we set up here. This is similar but not exact to the previous schedule for units of activity because in this schedule I'm putting beginning book value because that's an important number that we need. We didn't need that for the previous methods. We do need it for this method. Okay, now, book value we know is cost minus accumulated depreciation. Well, at the beginning of year 1, if we bought this on January 1st, cost minus 0 equals cost. So beginning book value in year 1 is our cost of 130. I'm going to multiply that times 40%, and my first year depreciation is $52,000. Debit depreciation expense, credit accumulated, 52. Remember, debits equal credits. Okay, so at the end of year one, on the balance sheet, my book value, 130 minus 52, book value 78,000. Now remember what we said about balance sheet accounts. When the clock strikes midnight on December 31st, the end of year balances convert into the following year's beginning year balances. So my December 31st year one ending balance is now my January 1st year two beginning balance. And there it is on the schedule, 78,000. I'm going to take 40% of that number, 78,000 times 40, and my depreciation expense in year two is 31,200. Debit depreciation expense, credit accumulated, 31,200. Accumulated depreciation in the general ledger now has a balance of 83,400, 1231.02. And my book value at the end of year two, December 31st, is 46,800, 130 minus 83,400. Okay, last year's ending book value, beginning of next year's beginning book value. 46,800 times 40%, depreciation in year three, 14,040. So I'm going to put that in my accumulated. Okay, remember, end of year three, debit depreciation expense, credit accumulated, 14,040. In the general ledger, my balance, 97,000. Whoops, I think I made a mistake up here. This is, sorry, this is 200. Now this would be 240 at 1231.03. Okay, book value, end of year three, cost 130 minus 97,240, 32,760. With the double declining balance method, same with units of activity, we got to be careful. In later years, we're not going to be able to take the full calculated amount, and we're going to see that next. So if my ending balance at the end of year three is 32,760, that's my beginning balance, year four. 32,760 times 40% is 13,104. Okay, now, if I added 13,104 to accumulate it, that would give me a balance of 110,344. And if I subtracted this from cost, my book value would be 19,656, which again is below 20,000 salvage. I can't do that. So I cannot record this full amount. And what I got to do is the same thing we did last time. I know that when accumulated hits 110, my book value would be 20,000. 130 minus 110. Got to know those definitions. So 97,240 plus X, whatever that number may be, has to equal 110. This number here has to stop at 110 on December 04. And so my depreciation, it's in red, can only be 12,760. I can't take the full calculated amount. Because now, 97,240 plus 12,760 equals 110. Okay, and simply the difference between these two numbers. And that's the depreciation expense I record in year four. Okay? Notice, year five, we cannot record any depreciation expense. Even though we're driving the truck, it is fully depreciated. We ran out of depreciation, and in year five, now we don't record zero, we simply don't record depreciation. And again, we may own this truck for another year or two, but we cannot record any more depreciation expense. It's a fully depreciated asset. And so with units of activity method and with the double declining balance method, especially if you have a large salvage value, you're going to run out of depreciation pretty quickly. You have to be careful. Sometimes you'll run out in year three. So you simply have to be aware of this issue related to these two depreciation methods. Okay? So we've looked at all three methods now, and on your own time you can review them, hopefully make some sense out of it. Okay? But this is a big area within property, plant, and equipment. Onward. Here's a good graph illustrating the three different depreciation methods. Notice, Straight line depreciation, each year I'm recording the same amount. That's that red line. That's why we call it straight line. The vertical axis is dollars of depreciation. The horizontal axis is time passed. Each year, straight line, we record the same amount. The green line, whatever that color might be, that's the units of activity, okay? Because as we do more or less driving, the depreciation expense that year is directly correlated with the amount of driving we do. If we drive more that year, we record more depreciation. If we drive less miles that year, we record less. So the green one, the kind of the zigzag one, that's our units of activity. And then the declining balance method, which we call the accelerated depreciation method, we record more depreciation in year 1, less in year 2, less in year 3, et cetera. If you look at your schedules, you will see how these graphs illustrate the numbers, okay? And so a company can choose whichever method it wants to record depreciation. Conceptually, the method we choose should kind of match or mirror how we're actually going to use the asset. If it's a building, probably straight line. If it's a machine like construction equipment that gets heavy usage, perhaps units of activity or the declining balance method. But again, it's up to each company, and in reality, straight line is by far the most common because it's simple. Okay. Now, in the United States, we are allowed to use a different depreciation method for tax reporting purposes. This is not a tax class. We're not going to go into it. I simply want to mention it, and we call it MACRS, Modified Accelerated Cost Recovery System. For those history buffs out there, go back to the 80s and the Ronald Reagan presidential era when the ACRS program first arose, and then a few years later they modified the ACRS program. ACRS was Accelerated Cost Recovery. And then they modified it, and that's where we stand at the time we're recording this lecture. Modified Accelerated Cost Recovery System. We use it for tax purposes, and it may produce a different number than the method we're using for financial reporting purposes when we prepare our financial statements. And we're going to stick with those three methods. We're not going to go into this at all. Simply mentioning it, you should be aware that we use it for tax purposes. You will see it more in an advanced accounting class or most likely in your tax class if you take a tax class. Okay. That brings us to some smaller issues which I want to talk about, and that's partial period depreciation. I'll leave this up here for now. If we buy an asset, or sell an asset for that matter, mid-year, anytime other than January 1st to December 31st, we have to calculate depreciation for those months that we owned the asset. Now let me give you an example. If we bought an asset on April 1st, okay, then we owned it April, May, June, July, August, September, October, November, December. We owned it for 9 months. We would have to calculate 9 months depreciation. If we sold an asset on April 1st, we owned it for January, February, and March. We did not own it April through December. We would record 3 months depreciation in the year of sale. So it'll differ depending on when we bought it, when we sold it. So we call this partial period depreciation. Using the same previous data, if we bought the asset on April 1st, instead of January 1st, we would have to record 9 months depreciation. So I use the exact same formula for straight line, cost minus salvage divided by 5 years, and I take that number, which you remember is 22,000, and I multiply that times 9 over 12. Or what you could do is you could take 22,000 annual depreciation, divide it by 12 months, that's monthly depreciation, and then multiply it by 9 months, same thing. And your depreciation in year 1 would be $16,500. Okay, and that would be your journal entry. Year 2 would be the full 22,000 depreciation. Okay, but in the year of purchase, year of sale, you might have a partial period calculation. Notice, we would do this with the double declining balance method as well, and that would affect each subsequent year's calculations. You have to be careful with that method. I think in the homework you may see that. But notice, units of activity is not based on time, but actual activity. So it does not affect the calculation for units of activity method if we buy it mid-year. But it would affect depreciation in year 1 for straight line method and for the double declining balance method. Okay, revised depreciation. Estimates. like salvage value and the useful life, can be changed if the business environment changes. For example, if we decide to keep a vehicle a few more years longer than originally expected due to a bad economy or a slowdown in our business has just not been very good the last few years, whatever, we can change these estimates, and we call this revised depreciation, and there's a specific formula, and it makes sense, but let's just take a look at it, and then we'll apply it. Formula to calculate revised depreciation equals current book value, which we know is cost minus accumulated at the point in time in which we're going to change the remaining salvage or useful life, current book value at that point in time, minus our new estimate for salvage value. It can go up or it can go down, divided by the new remaining useful life. And here's where you have to be careful, because depending upon what example you're looking at, they may give you the original years and then the new estimate for total life, or they may simply say these are the remaining years. You have to be careful in how you read the information. Okay, so we're going to take a look at an example to apply this. So new remaining useful life is our denominator. Okay, using the same data, cost 130, salvage 20, original useful life 5 years. If after the 4th year, okay, and so after the 4th year, here's accumulated depreciation, okay, 22,000 annual depreciation times 4 years, we would have 88,000 in accumulated depreciation after the end of 4 years, which means our current book value would be cost of 130 minus 88, and that would give us a current book value of $42,000. We estimate that we're going to keep this asset for 2 more years. Since business is slow, we can't afford to buy a new truck, and that would give it a total life of 7 years, 5 the original plus 2 more years. So the remaining life is 7 minus the 4 years we've already used it, so we have a 3-year new remaining life. And because we're going to hang on to this truck for 2 more years and drive it 2 more years, instead of a salvage of 20, we're going to decrease the salvage value to $10,000. That makes sense. Okay, so our new or revised depreciation, current book value $42,000, minus the new salvage of $10,000, divided by the new remaining useful life of 3 years, gives us depreciation for this year and the remaining 2 years of $10,667. Debit depreciation expense, credit accumulated. Okay, and that's our new depreciation for the remaining life, 3 years. Notice estimates can go higher or lower, longer or shorter. It just depends on what you think you're going to do with a particular asset. Okay? And for revisions of depreciation, we'll assume straight line depreciation to keep it simple. Okay. I've mentioned this a few times, but depreciation is not trying to determine market value. It's simply allocating or spreading out the cost. When we sell this asset, and when we sell it is whenever we decide to sell it, could be at the end of 5 years, could have been 4 years, could have been 7 years, it's really up to us. When we dispose of the asset, that's when we're going to try to get as much as we possibly can, unless we trade it in and we don't feel like dealing with a private sale. But whatever we get, that's going to really approximate market value, and then we're going to determine whether or not we have a loss on sale or a gain on sale. And so what we're going to do is we're going to compare what we call the cash proceeds to what our current remaining book value is to determine gain or loss on sale. We are not going to talk about exchanging one piece of equipment for another. That creates a lot of other issues that you would deal with in a more advanced accounting class. We're simply going to assume that we're selling this for cash, or we're simply just giving it away. We're just putting it in the back of the yard and let it sit there forever. Okay, after 4 years of use, accumulated is $88,000. Book value would therefore be $42,000. If I can sell this truck for $55,000, I would debit cash for $55,000. Now, when you sell an asset, you have to take it off your records since you no longer have it. And you don't want to report these assets in your balance sheet if you don't own them. That's fraudulent. So I have to credit property, plant, and equipment to show that I no longer have this asset. Okay? So I credit property, plant, and equipment for 130. If I don't have the equipment, remember, the only time you ever have accumulated is with equipment or property, plant, equipment. So I'm going to debit accumulated simply to zero out the account, get rid of it. And then notice, if you were to add up your debits, 55 plus 88 gives you 143. I only have a credit of 130. I would have what's called a gain on sale because my book value was 42,000 when I sold the asset, but because I maintained good care of the truck, I was able to recover 55,000. Okay? And so I'm going to report on my income statement in the other revenues and expense section, which comes below operating income, a gain on sale of 13. Notice that the gain on sale is a credit, which is like revenue, right? Revenue is a credit that increases our income. Okay, if we had sold this asset for less than book value, we would have a loss. Notice at the bottom of the slide, to determine gain or loss on sale, compare the proceeds, which is the cash received, to the book value. If the proceeds are more than the book value, we have a gain. If the proceeds are less than the book value, we would have a loss. Here's our loss example. We only got 24 instead of 55. Debit cash 24. Same thing, credit property and equipment for 130. Debit accumulated. And then to make the journal entry balance, I have a loss on sale of 18, which, by the way, is the difference between the proceeds of 24 and the book value of 42,000 at the time of sale. I lost 18,000. Okay? And again, notice, loss on sale is a debit, which is just like an expense. It reduces income. Last comment, and I don't have a slide for this, but simply, if I just put this truck, I drove it or pushed it into the back of the yard there, and it's going to sit for the rest of eternity, and it had a book value of 42, but it was just spent, it was just useless, I would put loss on disposal 42,000 because I wasn't able to recover anything for it. If I had a book value of 42 and I'm simply going to park it in the back of the yard there, loss on disposal 42,000. I didn't receive any cash. Okay? Okay. Last couple of items here. We have 3 ratios, and the ratios are related. Okay, we have the asset turnover ratio, the profit margin ratio, which we've previously seen, and we have return on assets, sometimes called return on investment, or ROI. So ROA, return on assets, ROI, return on investment. We'll stick with ROA. Let's assume the following information. Net sales, $2 million. Let's think back for a moment. Net sales, sales minus sales discounts, minus sales returns and allowances equals net sales, right? Net sales, $2 million. Net income, $400,000. And we need to know the beginning of the year value for our long-term assets, or total assets. We'll use total assets in this case. Different books sometimes calculate ratios a little bit differently. We'll stick with whatever's in our book. So January 1st, we had $400,000 in assets. End of the year, December 31st, we had $600,000 in assets. So we want to use a number called average assets. How do we get average? In any ratio, we take the beginning of the year balance plus the end of the year balance, and we divide by 2. And it gives us a rough average. So average assets would be 400 plus 600 divided by 2, or 500,000 average assets. Now let's look at these ratios, and we'll talk about what they represent. Okay, the asset turnover ratio, 200,000 net sales divided by average assets of 500, and what this is telling us is for each $1, okay, we have a ratio of 4/1 for the asset turnover ratio. For each $1 that we invested in assets, we were able to generate $4 revenue. And let me give you something to compare it to so you can think about this. If I have 2 different car companies, automotive companies, they both have a $1 billion factory. One factory runs 1 shift a day, 5 days a week. The other factory runs 2 shifts a day, 6 days a week. They both have a $1 billion factory, but this factory is producing a lot more cars and therefore a lot more revenue. It's a more productive asset. So this is a measure of productivity for assets that we've invested in. Have we made good decisions to invest in assets and get maximum utilization, or are they sitting idle too much of the time? So asset turnover ratio says for each $1 we invest in assets, how much revenue are we going to generate? Profit margin, which we've previously seen, is net income divided by net sales. Okay? So in this case, 400,000 divided by 2 million is 0.2, or 20% over 1. Okay? And what this is saying is for each $1 in sales or revenue, how much profit do we keep after tax at the end of the year? What goes into our pocket? Okay? And so this is a profitability ratio. And then return on assets says net income 400,000 divided by average assets of 500,000, 0.8, or 0.8 over 1, is for each $1 that we invested in our assets, how much profit do they generate for us after tax? Okay, so now notice, if I multiply the asset turnover ratio times the profit margin, I'm going to get the return on assets. Each $1 invested in assets generates $4 revenue. Each $1 of revenue generates 20 cents of profit. Therefore, each $1 of assets invested generates 80 cents profit. Notice how net sales, okay, we have net sales divided by average assets. Okay? And then we had what? Net income divided by net sales. Okay, so if we eliminate net sales, we simply say return on assets is the result of asset turnover ratio times our profit margin. Okay? And these are 3 commonly used ratios in business, and you should become familiar with them. Okay, and that'll do it for property, plant, and equipment.